Is the bumpy road to nowhere starting to go somewhere? Two-day pop on the S&P 500, biggest two-day move going back to about April. On the S&P 500 right now, new highs for the year. Equity futures positive 0.2%. On S&P 500 futures. On the Nasdaq, just about positive on the Nasdaq. Here's the opening bell, switch to the board and get to the bond market. Yields high on Monday, Tuesday, Wednesday, Thursday. Again this morning at the front end of the curve on a 10-year. At the longer end of the curve, higher by 4 or 5 basis points. Just south of 370, 369 there on a 2-year in America. Yields higher there, 6 basis points. We started this week opening up on a 2-year below 4%, right now above 430. Seen some dollar strength around that story. Euro dollar a break of 108 yesterday, just above it earlier, now just around that level, 107.97, positive 0.2%, and crude just about positive here, up by 8 or 9 tenths of 1%, $72 and about 50 cents. About 30 seconds into the session, positive 0.2% on the S&P 500. The number one stock to watch at the opening bell, Morgan Stanley. Here's the news. James Gorman announcing plans to step down as CEO within the next 12 months, telling shareholders at their annual meeting the following. It's the board's and my expectation that it will occur at some point in the next 12 months. That is the current expectation in the absence of a major change in the external environment. Shanali has more. Hey, Shanali.
Hey, John, if you take a look at it, of course, you have Morgan Stanley shareholders. Initial reaction being the stock down. You have to remember that James Gorman at Morgan Stanley was a huge reason that the stock has become one of the best performers in the market since he took over, only behind JP Morgan, and the rise of about 185% in the market since then compares with 95% over at Goldman Sachs in that same time frame. We've been talking about it a lot, the strategic shifts that he has made. The former McKinsey executive here had really made these tough choices over at Morgan Stanley that paid off in the longer term. Now, if you think about the next generation here, that is the big open question. There are really 3 people to watch here. We've been talking about Andy Saperstein, who has really reshaped the wealth business. We have talked about Ted Pick, who has been the leader of the institutional business, grew up in that business, went through some very tough changes in that business over the last even 5 years alone, but also Dan Simkowitz. We should talk about him as well because he runs that asset manager, which just 5 or 6 years ago, you couldn't even imagine surpassing $1 trillion. And here we are, Morgan Stanley competing, previously the little sister of the industry, and now competing with the giants.
It's turned around in a massive way with his leadership. Shanali, we talked about Goldman and the race to take over from Blankfein back in the day, Harvey Schwartz, David Solomon. Let's talk about this race and maybe offering a template for what might happen or might not happen at JP Morgan. Just this elegant move away from the CEO role, just to sit there as the chairman. Is that a template for elsewhere, do you think?
I think it is a template because the new generations over at JP Morgan, for example, they are quite homegrown, but there are a lot of questions about what such a big bank would look like without Jamie there. So it is an interesting solution to have them in the sidelines. Remember, the age is also different here. James Gorman is turning also very elegant 65 years old this year. That is the age now that is seen as the kind age to start turning the page as Jamie Dimon has been at the helm longer. He has done more acquisitions over a long period of time. He is really so rooted in this firm. He's 67. And so there are real questions here about when he is also going to turn the page and whether his deputies are ready.
5 years. It's usually just 5 more years, right?
5 more years.
Not 12 months. But
One day,
when he
maybe.
says 12 months, then it gets serious. Shanali, wonderful coverage. Looking forward to your coverage through this morning. Morgan Stanley negative by about 1% in the early part of the session. Let's turn to earnings quickly. Deere raising its full-year profit forecast amid strengthening demand and easing supply chain woes. The CEO saying this: we continue to benefit from favorable market conditions and an improving operating environment. Abby has more. Hey, Abby.
Hey, John. Well, it's interesting because peak ag, the fears that peak ag, we may be seeing it. It's not hitting Deere's results, at least not in this quarter. A big quarter. They beat earnings in a big way. Adjusted earnings were 18% beat, $10.11, an 8% revenue beat, almost $16.1 billion. So big numbers, growing. They raised the outlook to your point. Interestingly, this stock is down on the year, but now thanks to today's pop, the best day since early February, the shares of Deere are down less than 10%. So it seems as though they are turning a quarter, but more is needed because some analysts are still concerned that peak ag could drag. But at least right now, Deere managing that very well.
Stock up more than 3%. Abby, thanks for that. Let's take a look at Disney. The company announcing plans to begin removing programs from its streaming service. Just the latest step in its efforts to reduce losses and cut costs. The stock's down by 1%. Kelly Lyons, there is so much news around this company in the last 24 hours. I don't know where to start.
Yeah, well, if we start there with the streaming service, these are shows that they already had decided not to renew, but now they are removing them from the service entirely to avoid the additional costs like paying residual fees to the participants in the shows. Again, trying to return this business or bring it really to profitability. The other news, though, comes down in Florida, where Disney has canceled plans to relocate 2,000 employees from California to the Sunshine State with an $864 million campus they were planning to build no longer being built. They're also going to shutter their Star Wars hotel that costs, mind you, $4,800 minimum for 2 nights. This is amid the ongoing fight Disney has with Florida Governor Ron DeSantis. They didn't mention that directly in these announcements, just cited changing business conditions. So maybe read between the lines there, John. But the governor's office did put out a statement saying this move wasn't surprising given the company's financial straits, falling market cap, and declining stock price. And again, John, the stock price is declining this morning, down a little more than 1% here at the open.
92.65. Katie, thanks for that. That's the wrap with Disney. Where to start, where to end. Disney getting a downgrade. Shares of Disney downgraded to neutral over at Macquarie. The team over there writing the following: linear networks are getting worse fast. Ad revenues will likely remain negative in the fiscal third quarter, and affiliate revenue may remain negative for good as cord cutting gathers speed. We see the stock as range bound for now. That stock, as Katie indicated, is down about 1% this morning. What a shift to retail. Shares of Foot Locker getting absolutely hammered after cutting their annual sales forecast. The CEO saying the company's revenue has, quote, softened meaningfully given the tough macroeconomic backdrop. Isabel Lee has more. Hey, Isabel.
Hi, John. Tough indeed. If you need more evidence that Americans are pulling back on their spending, look no further than to Foot Locker. The company cut its annual sales forecast, saying revenue will fall by as much as 8% this year. That's down from the initial 5.5% that they projected. Profit forecast is also down, now seeing adjusted earnings of as much as $225. That's lower than the previous high end of the 365 revenue. Shares are tanking indeed. It's now down by around 25%. Year to date, Foot Locker is also down by 16%. But John, this is a broader story because Foot Locker isn't the only one warning about this. We have Home Depot, Target, Walmart. The U.S. is really seeing a big demand problem, John.
A quarter of the value of that company gone, just like that, in 6 minutes of trading. Isabel, thanks for that. The broader market right now, through 4,200 on the S&P 500, just positive by 0.24% on the S&P. Looking ahead to Chairman Powell a little bit later on this morning. It was nearly 9 months ago, on August 26th, 2022, that Chairman Powell said this.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
That was Jackson Hole 9 months ago. So what happened next? The unemployment rate that summer, 3.5%. The unemployment rate now, 3.4%. As for the market, the morning that Powell delivered that speech, the stock market opened up at 41.98. Yesterday, the stock market closed at, guess what? 41.98. Joining us now to discuss, Morgan Stanley's Jim Caron. Jim Caron, what pain?
That's a good question. Well, there was some pain along the way, and that's absolutely for sure. But I think all the focus right now is on thinking about what the Fed's next move is going to be, and I think that they're going to stay on hold. So, look, I mean, the market is not the economy. The market is doing reasonably well. There's no question about that. But when you look at the economic data, it's holding up better than many people had thought. And you had mentioned earlier on the show that the Atlanta Fed now, GDP now, is even close to 3% for the second quarter. So all of that is really, really good. But we do have to recognize that the run rate of growth for this entire year is probably closer to 1 to 2%. We may get some slowing in the economy in the second half of the year. That certainly may be the case. But it's certainly not the disaster scenario that many people have been forecasting. So, look, the economy is slowing. We've hiked rates 500 basis points after all. It's supposed to slow. So the next move by the Fed, I think, is really just to stay on hold. The next move is no move.
What would you expect to hear from Fed Chair Jay Powell later this morning, Jim?
I think more of the same. I think that they're going to talk about this in not so many words, a higher for longer, getting to sufficiently tight policy levels. And sufficiently tight, that's going to be the code word, meaning that sufficiently tight means that they can hold those levels there for an extended period of time. And I think that's going to be the statement that I'm looking for. If he says something along the lines of, potentially financial conditions need to tighten more or something like that, then I think the Fed's back in play. But I think sufficiently tight monetary policy levels is essentially going to be his message.
We need to get a market call. Tony Dwyer of Canaccord Genuity, good friend of this program over the last week or so, said to us he was too nervous to get short, too anxious to get long. You say this, Jim. It's a moment to be balanced. Can you tell us what the difference is between balanced and defensive? Because I hear defensive a lot. What does balance mean?
So balanced means balanced is an asset allocation decision, meaning that you're balancing the risks both upside and downside. And John, you and I have spoken about this all year. One of the things I've said is that risk on is a risk like any other risk, and it needs to be hedged. And what defensive is a style. So defensive positioning is when you expect an economic outcome and you position for it. And what we decided to do at the start of the year was really have more of a balanced look and basically say, look, there could be some downside, there could be some upside. Let's position a portfolio so it's durable if either scenario occurs. A defensive style portfolio is going to be one that's going to be more rooted in fixed income and more defensive equity related sectors and what have you. So that's not the kind of environment that we're in right now. I think that the risks in the economy today and in the market is more balanced upside and downside than what the consensus bearish narrative would suggest. So I think a balanced portfolio that really allows you to play for both either the upside or the downside, so it's a good asset allocation strategy, well-diversified portfolio, is better than selecting what you believe will be a defensive outcome or a negative outcome and positioning defensively because of it. And that's why we think it's better to be balanced than defensive.
So Jim, can you walk us through how you would be balanced? And can we just start with positioning for upside? How would you capture that upside? What pockets of the market are you sitting in for that?
Yeah, well, first of all, the equity market. I mean, essentially, what is a balanced portfolio right now? Is it 60-40? Is it 50-50? What is the case? What we've seen is that there's been an underweight to equity risk. People have favored cash and they favored fixed income, and you can see that from building cash levels. One of the things that we've put into our portfolios is a more aggressive, higher allocation to equity. Now, our allocation to equity right now is roughly about 50 to 55% relative to fixed income. That's not extraordinarily bullish. That's relatively balanced at this point. But when we compare that to the narrative in the market and the positioning that we see in the market, if you look at long-short ratios and things like that, the markets are pretty much underweight equity risk. So all we're saying is get back to more of a neutral equity component. And John, look, one more thing. When we look at the equity market, it's 25% up in tech, it's 3% up in consumer discretionary, and 3% up in industrials. Everything else is flat to down. So this is not a wide breadth market. If we do get some reasonable economic data and growth, the rest of the broad market could actually start to do better. And it's coming from a negative on the year. So there are some positive possibilities that I think that we need to hedge for. We could disappoint to the upside, is the way I like to say it.
Jim, that's the equity side of the story. Can we throw in credit as well? Credit just seems to be stuck somewhere in the middle right now. How are you playing that?
So our view is that we're not going to have a hard landing. So as a result of that, we see default risk as being relatively low. But we also think that the interest rate markets, the government bond market, has priced in, and well, at least a couple of weeks ago anyways, or even the start of this week, had priced in a lot of rate cuts. So one of the things that we're doing is we're allocating more towards high yield and more towards credit to collect the coupon, the all-in yield, but we're reducing the interest rate sensitivity of the portfolio. So that means that we're trying to step away from U.S. Treasuries and we're trying to add more towards high yield and towards investment grade credit and even non-agency mortgages. These are areas that we think are going to do reasonably well in a non-hard landing scenario, and that's our base case.
Hey Jim, love it. Great to catch up. Jim Karen there of Morgan Stanley talking about disappointing to the upside. Disappointing if you're not positioned for it. 3-day gain on the S&P 500. About 13 or 14 minutes into the session, the S&P is up by 0.3%, advancing once again. Michael Hartnett of Bank of America, great note again this morning from Michael and the team over at B of A. It would be so on brand for stocks to melt up into recession, suck them all right in before the hard landing. This is we reprice the yield curve higher, particularly at the front end of the curve over the last few days. Every single day this week, this 2 years been higher. Started the week just south of 4%, right now north of 430, 433, call it 434 on a a 2-year, up by 8 basis points. Euro move starting to fade again, 107.93, just seeing a touch of euro strength after a few days of dollar strength on the other side of the trade. And if you are just tuning in, the latest news this morning, James Gorman planning to step down from Morgan Stanley, announcing at the firm's annual meeting, it is the board's and my expectation that it will occur at some point in the next 12 months. That is the current expectation in the absence of a major change in the external environment. That stock is, at the moment, Morgan Stanley, slightly negative this morning. Coming up on this program, plans taking shape for a debt limit vote on Capitol Hill.
The negotiations are currently making progress. As Speaker McCarthy has said, he expects the House will vote next week if an agreement is reached, and the Senate would begin consideration after that.
That conversation up next.
The negotiations are currently making progress. As Speaker McCarthy has said, he expects the House will vote next week if an agreement is reached, and the Senate would begin consideration after that. Members should remain aware and be able to return to the Senate within a 24-hour period to fulfill our responsibilities to avoid default.
Everybody playing nice for now. According to a White House official, Biden telling his hand-picked negotiating team in Washington that he's confident Congress will act in time. Speaker McCarthy also sounding confident.
I see the path that we could come to an agreement. And I think we have the structure now, and everybody's working hard. And I mean, we're working 2 or 3 times a day, then going back, getting more numbers.
The mood music sounds okay. The numbers do not. The Treasury's cash balance dropping to 68.3 billion, according to the latest data. That's down from 94.6 billion a day earlier, down from 140 billion at the end of last week. With Axios reporting at the moment, the Secretary Yellen is warning both publicly and privately that the early June next day is real. Kaylee Lyons joins us now from DC for the latest. Hey, Kaylee.
Hey, John. Well, I spoke with a former Treasury spokesperson on balance of power earlier this week who also said we should take that seriously. No joke, no smoke. If she says as early as June 1st, that date is real, especially as you alluded to. We do have the Treasury's cash balance now at the lowest level since 2021. So that just speaks to how tight the timeline realistically is here. Even if we do buy the fact that progress in the talks is happening, all of this optimism is actually real, that compromise still needs to be turned into actual legislative text, put on the floor of the House, voted on, passed on the Senate, voted on, passed, and then ultimately get to the president's desk. That is a lot that has to happen in a less than 2-week period in theory, and it does become a question of the vote count as well, because we understand that work requirements for entitlements has become a real sticking point. That is not something that progressives in the House would like to vote for. It's a big issue with the Congressional Black Caucus as well. Then in the Senate, you had a group of senators, including the likes of Senator Bernie Sanders, writing a letter to the president yesterday saying that he shouldn't be giving things up. Instead, he should evoke the 14th Amendment. At the same time, the House Freedom Caucus also put out a statement yesterday saying no further negotiations should happen until the Senate passes the bill the House passed. So what it feels like, John, is that at the sides of the parties, they seem to be moving away from the idea of compromise at the very same time that those in the middle, those negotiating, are trying to move toward it.
And Kaylee, you said it. You went through the process there. That piece of it, voted on, passed. Is that the piece of it that a lot of people in Washington are nervous about at the moment?
Yeah, that's really what it comes down to now, John, is the vote count. Because if we are starting to see the contours of a deal forming, what really contains in it and whether or not it is passable is going to be key. Because remember, Speaker McCarthy made a lot of promises to certain members of his caucus just to get the initial bill he passed through. Many in the Republican Party likely would not want to vote for a package that saw a lot of that taken away. So you're going to need some Democratic votes. But again, there are Democrats who have serious issues with some of what measures could be on the table here. So the math could get very tricky on both the Republican and Democratic side, John.
Kelly, thanks. That's the roundup down in Washington. I mentioned that story from Axios. Here's the lead paragraph from it. Treasury Secretary Janet Yellen warning the country's biggest bankers that a potential debt ceiling default will have repercussions beyond the financial system, and insisted, this is the key part, that the early June X date is real. That's their latest reporting this morning. The latest price action this morning, 22 minutes into the session, we are just about positive on the S&P for a third session, up by 0.3% with a sector price action. Here's Abby.
And being higher for a third session, John, means at least this week that the S&P 500 is up more than 2% on the week, the best week going back to March. As for sectors today, energy leading the way, up 1.3%, with oil higher. Healthcare is also up 1%. Only 2 sectors are down, technology and discretionary. And in the middle, we have financials. They are up about 0.3%, despite the fact that on the day, Morgan Stanley is down. Last time I looked, down by about 1% on this news that Morgan Stanley's CEO, James Gorman, is to step down within 12 months. On the week, though, Morgan Stanley is higher. That's true, too, for the financial sector, with lots happening also for the regional banks, up about 3% there for the financials. Taking a look at some of the other sectors, we have lots of the big tech sectors higher, communication services. We also have the tech sector itself higher, consumer discretionary. So those are the 3 mega cap tech sectors, and there's those financials again. Net, John, a bullish week.
Abby, thank you. A better week on many fronts as we inch towards the weekend. Before we get to the weekend, a few more things to get through. Your trading diary up next. Three-day winning streak on the S&P 500. We'll see if this sticks. Longest winning streak on the S&P going back to early April. That's the price action right now. Let's get to the trading diary. It looks like this. Fed Chair Jay Powell speaks at 11 Eastern time. Then looking ahead to next week, JP Morgan's Investor Day coming up on Monday, plus more Fed speak from Bullard, Bostic and Barkin. Looking further into next week, another round of new home sales. And then Wednesday, we get the FOMC minutes as well. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and have a wonderful weekend if you can. From New York, this was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, May 19th. Here are the top market stories we're following for you at this hour. Morgan without Gorman. Morgan Stanley CEO James Gorman announcing he will step down in the next 12 months, ending a 14-year tenure at the top of the helm there. Stock is down by about 0.5%. AI's baby bubble. Bank of America sounds the alarm on the AI trade as investors buy tech and load up on bonds and cash and hold, hike, or hop. The latest read from the Fed could be just skipping a hike at the June meeting rather than wrapping up its tightening cycle. Stocks pretty much flat on the day. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Yep. We were just kind of powering through Friday, and then the Gorman news kind of threw it all up in the air. It feels like we were kind of waiting for when this would come down, but a fascinating development in the financial industry.
Absolutely. This is a man who has transformed Morgan Stanley into the beast that it is now on Wall Street. The performance is absolutely sensational. It's basically the Morgans that have done really well. Morgan Stanley, JP Morgan. You compare and contrast the performances they have delivered versus all the other banks. Alex, absolutely sensational. Leaning on the wealth management business was just so the right call. The E-Trade sort of trade was the right call. He didn't put many feet wrong, did he?
No. Also, I feel like you mentioned the Morgans, right? The tale of the two Morgans. I wonder if this sort of turns up the heat a little bit on Jamie Dimon, who's always super cagey about when he's going to retire. And now it's like, well, is it going to be more like, no, seriously, when are you going to retire?
No, Monday. It's either Monday or Tuesday. I can't remember. Is JP Morgan's Investor Day. You're absolutely right. The heat has definitely been turned up. It's Monday. They're telling me in my ear it's Monday. I think the pressure is on. Another 5 years has always been the line, but we'll see. At some point, that has to come to an end. Anyway, Jamie Dimon, we'll deal with him next week. Mr. Gorman is the subject of our attention right now. He's been there since 2010, Alex. He's announced today that he's going to step down in the next 12 months as CEO. He's going to continue at the bank as executive chairman. We've been asking him for years about succession planning. This is what he has been saying.
I gave the board an indication, I thought, given my age, that a 5-year period felt very reasonable. They're very supportive of that. This organization has been built over many decades, and it takes a long time for talent to rise to the top.
So I'll re-ask the question: the next decade, will one of those women be the CEO?
I think there's a distinct possibility, but I can't guarantee it. It's for the board. What I'm doing is giving the board choices. We at Morgan Stanley have now 3 executives who could replace me. They're all very, very talented executives, and we're trying to fill out their skill base, and ultimately the board will decide who is the best qualified to run our particular company at this point in time.
So we have been inching towards this moment. That was the choreography, that was the build-up. It's taken a lot longer than maybe some people had anticipated. Our question of the day is a fairly straightforward one. Alex has already said it. What's Morgan without Gorman? Morgan Stanley, of course. Shonali Basak, Alison Williams of Bloomberg Intelligence joining us now. Shonali, he transformed this business. He built it into the beast that it is now. The performance that you can see in the share price backs that up. What is Morgan Stanley going to be without James Gorman?
By the way, I don't know how funny it is that you guys realize that inside of Morgan Stanley, they call JP Morgan JP Chase. And so in their minds, they are the Morgan. However, what's interesting about this is the people in line to take charge next, because you have Ted Pick, who has been there in some of the toughest of days inside that institutional securities business. When he really started to change the business, fixed income was not punching at the same weight as the Wall Street giants. Now it's closer in line to that size. A lot of competition in equities over at the wealth business, by the way. Andy Saperstein is one of the key candidates here as well. Morgan Stanley is expected to bring in trillions of net new assets over the next several years, so he's pivotal to the strategy moving forward. And then there's Dan Simkowitz, which I did the math on this. I think 2019 they had less than $500 billion in assets. Now they have well over $1 trillion in assets. But you can see, without knowing who's going to take over next, it is hard to lose Gorman. That chart right there will show you that Morgan Stanley has risen 185% since Gorman has taken over, 95% for Goldman Sachs. So that's the difference.
Alison Williams, to this point, is there a Gorman premium in the stock price?
So I think there is a premium in terms of execution, and Gorman certainly has led that, but the strongest leaders, as you know, really build a culture around their firms. And so I think that, Gorman transformed the business. Wealth and asset management was about 52% of pre-tax. In 2022, that's double the 26% in 2010, and the large majority of that happened under Gorman. We expect that continues. And so when we look at the valuation of Morgan Stanley and other investors, in general, you compare it to other investment banks, but it has started to tilt more towards the wealth and asset management business, which is tends to be more favored by investors because of the relatively more recurring nature of those revenues.
Alison, whoever takes over, will they be a continuity candidate?
I think there will. So it seems the two biggest contenders are Andy Saperstein, who heads Wealth. He was elevated to co-president along with Ted Pick just almost exactly 2 years ago. Dan Simkowitz is also a contender running investment management, but we do think that, the two other sizable businesses and the leaders of those businesses, it will likely be either Andy or Ted. The firm has tilted towards wealth and asset management. We expect that tilt continues. That could favor Saperstein, but at the same time, Ted Pick has also shown himself to be someone who really transformed the business. He revamped fixed income trading. He took over equity trading. They've gained share in those businesses long term.
Okay, but where's my diversity, Shonali?
That's a great question.
You saw Sherrod Brown sort of pressing on will one of the next CEO be a woman, and there was a lot of sidestep in there.
Right, and it's interesting here. You do have some women at the top of Morgan Stanley, very interesting women. You have Sharon Yeshaya, who is the CFO, but you remember Ted and Andy and Dan have really been so pivotal to the changes of so many of these businesses. Remember, the top of Morgan Stanley under Gorman has changed a lot. We have watched the succession race play out year over year over year. We have seen the loss of Paul Taubman and Colm Kelleher and, John Pruzan even more recently. And these are really the three people that people have been watching over a long period of time. And frankly, who they've put in front of some of the toughest changes inside of the firm. So it is hard to see a woman taking over at Morgan Stanley at this point in time. But, I don't want to say that that doesn't mean diversity is dead on Wall Street or anything like that, because there are women rising at many firms, including Morgan Stanley and others. Women could still lead an investment bank. It just probably won't be Morgan Stanley.
Alex, we talked about it just a moment ago. Monday, you've got the JP Morgan Investor Day. The pressure's got to be on, right?
Yeah, you love talking to Jamie Dimon. He's always like 5 years, 5 years, 5 years. That was like 20 years ago. Allison, I wonder though, seriously, does this put the pressure on for JP Morgan to sort of outline a little bit more in terms of their, we lost you? Oh, she's back. In terms of the succession plan and sort of what we might hear on that on Monday?
So I think that obviously there will be questions there on the succession planning. I don't think this will necessarily change what Dimon will say. We expect that he might say another 5 years again. And, I would point out that JP Morgan actually has, I think, been at the forefront in terms of including diversity in their senior ranks. Marianne Lake, who's one of the most senior women on Wall Street, she was their CFO. She did an amazing job. And now she's running one of the core consumer business along with Jen Kuczak. And we think that the Investor Day really, for them, will much more focus on what's happening on the expense front. The Investor Day is always a great time to dig into things. Last year, we heard a lot about expenses and where they're investing and what those investments were yielding, and we think that we'll hear some of that tomorrow. Also, we're looking for an update on First Republic and broader thoughts on the economy.
And I'm sure we'll get all of those, but 5 more years has definitely got to come up. Shonali, 5 more years?
I don't know that it could last that long. One of the things that I had been looking at is relative age.
My phone was ringing. That's why.
She's busy. Everyone's ringing today, I think. 5 more years is interesting because James Gorman turns 65 this year, and we're seeing many people this year start to step down at 65. That seems to be the elegant age to start to make this transition. James Gorman has been saying that he would remain as executive chairman, which gives you some wiggle room here in terms of, you're tossing the baton on. However, you're there still. You're a safety net in essence if things were to go wrong. But yes, 5 more years over at JP Morgan. This is a time, Guy, where we're seeing left and right, the next guard of Wall Street, starting to step it up.
So do we have an idea of what that talent actually winds up looking like? Is there a broad theme here? Because this is obviously a very different environment than 15 years ago.
I think one thing that's interesting to remember for Morgan Stanley, it was really a former consultant, James Gorman, former McKinsey, reshaping the firm. That idea of strategic thinking that has not been, frankly, well executed at every other firm. We have seen a lot of strategic missteps over the last 10 years from certain banks. So this idea of a consultant, and another one, Andy Saperstein as well, longtime deputy, potentially taking over, is an interesting kind of change and continuation. Over at other places, you have, or even at Morgan Stanley, Ted Pick, Dan Simkowitz have investment banking backgrounds, as well as some trading too. But you also have over at JP Morgan, Jen Pipsack was also a former investment banker. I think these skills and what people develop as they're in these firms are really interesting to watch as you watch the new guard. I think it matters for the people who are rising up in the businesses because you want to put yourself in the position to succeed. The skills and the businesses that will be the main businesses on Wall Street tomorrow are definitely not always the same ones that will have succeeded in the past.
Yeah. I think there's a dotted line here to Marcus at some point. Yeah, All right, thanks a lot. Really appreciate all of you. Allison Williams, Shalai Bassick, thank you both very much. So coming up more on the question of the day, what's Morgan without Gorman? Steve Sosnick is Interactive Brokers Chief Strategist. He joins us next. This is Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
The world will certainly get through this period of high rate increases to tackle inflation and obviously the slowing down of economies around the world for a period of time. But I remain extraordinarily optimistic about the future of Morgan Stanley and our broader economy, whatever the next several months brings.
That was Morgan Stanley CEO James Gorman earlier this morning at the firm's annual meeting, which brings us to the question of the day. What is Morgan without Gorman? With us now, Steve Sosnick, Interactive Brokers Chief Strategist. All right, what do you think?
Well, first of all, you literally cannot spell Morgan without G-O-R-M-A-N.
I know. I have to give credit to Guy for that one.
Yeah, so there you go. But, you know, I think the key is here. He's built the firm through all kinds of acquisitions. He's been a brilliant acquirer. They were really not, you know, they didn't handle small retail, but then they bought E-Trade, quite honestly, making them a competitor of ours now. And, you know, their asset management business, it's all been, much of it has been through acquisition. And so maybe now you translate from an acquisitive CEO to a managing CEO who puts all these disparate pieces together. I think that's going to be their interesting challenge.
In terms of, he was a wealth management guy, right? That's ultimately what he became. That's where he took the business. So let's talk more about that, Steve. As we look at the markets going forward from here, what do you see? The markets have been dull as dishwater for a very long time. We have been in a range. Bond markets are starting to break out. Equity markets may follow. What do you think happens next?
The key here is the 4,200 level, which is where we're flirting right now. It was fascinating. On Tuesday, we actually closed dead unchanged on the quarter, like within less than 1 point on S&P 500. Now we've obviously had a bit of a move since then, and you know it's been on debt ceiling enthusiasm. You know, the questions to me are: can we break through this 4,200 level, which has provided resistance on the last couple of attempts? And the other question is: if we get an agreement on the debt ceiling, is it now a buy the rumor, sell the news event? Mm-hmm. Because we weren't really pricing it in before. Now we're pricing in the good news, and now if we get the deal, does that become the buy the rumor, the sell the news part?
Well, before we get to the longer term thing, Guy, we have about $1.7 trillion of derivatives contracts expiring today, the stocks and indices, and a lot of the calls are pegged to 4,200, guys. So it's going to be interesting to see what if you roll it over and they expire, sort of what pickup there isn't on Monday.
Yeah, and there's a lot of people who've been talking about the fact that it's been the algos driving the market recently. The humans have been sitting out. They don't like this market. They don't like this rally. But Steve, if we get a breakout to the upside, do you think people are going to chase it?
It's human nature, right? I mean, you know, FOMO is an amazing motivator, and I think that's kind of what we're seeing already. You know, the AI enthusiasm does have a big ring of FOMO to it. Nobody wants to miss the AI trade, just like no one wanted to miss crypto, just like no one wanted to miss blockchain, just like no one wanted to miss the internet. We've seen this movie before, but what we also know is that this can persist for some time because it's the hot, sexy topic right now.
Yes, and we have an amazing chart that just shows the amount of times that AI is mentioned on conference calls just this quarter. And sort of you can look at some stocks might mention AI and all of a sudden, boom, their stock goes up. So to that point, Bank of America called it a baby bubble. But the baby bubble can grow to a bigger baby bubble. So like, what do you do with that? How do you hedge that?
What you do is you basically, if you want to hedge it, you buy insurance basically, and that's kind of, right now insurance is very cheap. It's funny you mentioned. Well, you can buy puts on, you know, the asset when you have a VIX with a 15 handle. That's a pretty inexpensive time to buy puts. Remember, when you buy insurance, you're not hoping insurance pays off, right? You know, like if you buy fire insurance on your house, you kind of hope you waste those premiums, but you ask how you hedge it, and that is one of the ways you do it. As far as how many times I mention AI, the mother of them all is next week when NVIDIA reports, because they mentioned AI like 50 times before the call even started in the prologue. So that may be, you may, on that sense, you may even want to hedge that specific stock because it is such the bellwether of the AI enthusiasm.
Yeah, they have some reason to talk about AI. Some of these other calls, I'm not entirely sure, but people have been benefiting from it. You guys are just talking about the VIX. Is the VIX cheap at 15, or is it expensive?
You know, it's funny. If this were like a high school debate, I could do either side. If you look at historical volatility, it's actually kind of expensive because until this week we did nothing. So the historical volatility was like a 9 or a 10. So 15, 16 VIX is relatively elevated. If you think that the debt ceiling does not necessarily become smooth sailing, or you think it's a buy the rumor, sell the news event, it's cheap because VIX has a way of exploding. You know, right after the Fed meeting, we went from 15.5 on Monday to 21.5 on Thursday, and that really wasn't even much of a sell down.
So I guess my question then becomes, how does the debt ceiling play into this? Because again, you can argue both sides. Like one, yay, okay, so debt ceiling, you can buy stuff that maybe you weren't buying because you were scared about the debt ceiling. What does that do to tech? And the other side is the liquidity that's going to be drained out of the market because now you're going to see Treasury issuing a ton of bills. How do you play that?
Well, I think what you do is I think you just got to stick to your fundamentals here and buy the stocks that make sense to you.
Yep.
And that's really the only way you can really play it, because if you start chasing trends, and equity markets are really terrible at macro and political events. It's just not their wheelhouse. And so I think you're much better off being bottom up in that situation than
Yep.
top down.
Okay, I hear what you're saying, but let's talk macro and equities in the same sentence, Steve. How do you hedge in equities the risk of the Fed hiking at the next meeting or the meeting after that, and of the Fed going to 6%?
Again, the equities are not the best way to hedge the Fed. So I keep coming back to, either puts on specific stocks that are specifically affected by this, potentially financials, or you start to look more macro at VIX or similar type of broad-based ETF hedges as well. That really becomes your way to hedge the macro. Although I will say that hedging interest rates via equities is not necessarily the preferred way to do it.
I hear what you're saying. I had to ask the question, tie it back in. Steve, lovely to see you. Always a pleasure. Steve Sosnick of Interactive Brokers. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest stories in the news right now. I'm Lisa Mateo. Morgan Stanley's James Gorman plans to step down as chief executive sometime in the next year. Gorman, who's been CEO since 2010, will assume the role of executive chairman. No word yet on who will be the bank's next chief. In January, Gorman said there were 3 finalists for the job. Shares of Foot Locker are plunging. The sports shoe retailer cut its full-year sales outlook and reported first-quarter sales fell more than 9%. Foot Locker also said that merchandise inventories were 25% higher than at the end of the first quarter last year. And the U.S. tractor maker Deere has raised its full-year profit forecast. The company sees rising earnings thanks to strong demand for farm equipment and the easing of supply chain problems. Deere is a bellwether for the health of the agricultural industry. It's the world's largest producer of farm machinery. And that's your Bloomberg Business Flash. Guy.
Lisa, thank you very much indeed. Alex beating the raise, can't argue with that. Stock prices up really quite nicely. The question is, and analysts have been talking about this today, are we at or close to peak ag? You've got grain prices coming down a little bit. The inventories at some of the dealerships are starting to rise a little bit. It feels like that's a definite possibility.
Well, yeah. I mean, you get the stock a little softer, down by 0.5%. Also, sort of what was actually priced in at that point. But, you know, I got to say that they are able to pass on prices, too. And if you wind up having demand staying strong, particularly with some farmers dealing with, you know, wheat, for example, and the frozen crops, the prices are going to kind of shoot higher. Does that translate in the future of more order equipment, et cetera?
I don't know. What I do know is that farmers bought a lot of kit recently.
True.
It's a bit like, is it a bit like TVs? Have we bought all the tractors? You can never buy enough tractors, I appreciate, but have we bought enough tractors?
I know, but it's like, is it peak plain? Like, you know, I don't know how we know. If I said peak plain to you, you would be crazy.
Well, yeah, exactly. You could never have too many planes, but you can never have too many tractors either, to be honest.
That's what I'm saying.
So maybe you do need more. But I think the point is a valid one. There's a lot. The other thing that's happening in this industry is that it's becoming increasingly automated and digitized, and that has been a big driver as well. And those secular trends I don't think are going away.
No. Also, I should say on the call they're talking about supply constraints, but they still see some supply chain constraints as well. And the shares were up a good solid 6%, so losing some of that speed kind of makes a lot of sense. Okay, so definitely watching that stock through the open. Coming up, you got Morgan Stanley CEO James Gorman announcing he is stepping down. We're going to continue that conversation with former chair of the FDIC, Sheila Bair. This is Bloomberg.
At that all day yesterday.
about an hour into the U.S. trading session. Look at the overall index. It's kind of a meh, but a lot of fun things happening underneath it, and we are above 4,200 for the first time in a while. Abigail's tracking the moves. Abigail?
And on the week, Alex, take a look at these gains. I mean, this is a risk-on week for stocks. For the S&P 500, thanks for pointing out that 4,200 level, because we've been looking at ranges that suggested that could be possible. Now it's going to be interesting to see what happens. But we are looking at the best week since March. You can see gains for the NASDAQ 100, the Russell 2000, so a broad-based rally. Take a look at the KBW Bank Index, up 7.2%. I meant to do a SINS function to see when this is the best SINS. This might be the best week of the year for banks, so really starting to look past perhaps the bank turmoil. Making all of this impressive is the fact that we also have yields rising. Now, it makes sense. Bonds are trading lower, so investors going into risk asset stocks, but we also have this dynamic more recently, or over the last year really, where when yields go higher, that means stocks down because valuation comes into question, fear that the Fed is going to keep hiking, and of course there is talk that the June meeting is active for a potential hike, but nonetheless, even with all this, stocks higher. Let's check in on that S&P 500 range, but let's do it on a weekly basis since our theme here is weekly. This is the brutal downtrend, bear market of last year, then the sideways trend. These are fan lines, so these represent waves of selling. I had a request on Twitter not so long ago to take a look at this chart again, and you can see that the S&P 500 staying above this third trend line wave of selling. I wouldn't be surprised if at some point it were to retouch it, but if not, you have a very clean breakout that's been developing for weeks. This suggests that the S&P 500 may keep climbing, although I will say there's so many nuances. So we will return to this at some point. And then finally, the big story stock of the day, Morgan Stanley. Last time I looked, it was off of its lows, down about 0.3% on the week, up nearly 2%. And Guy, this of course includes the news that CEO James Gorman plans to retire as CEO within 12 months.
Yeah, you do wonder whether there's a Gorman premium built into the stock. Abigail, thank you very much indeed. Our question of the day kind of goes to that point. What's Morgan without Gorman? Let's find out. Former FDIC Chair Sheila Bair joins us now. She's now a Senior Fellow at the Center for Financial Stability. Sheila Bair, great to see you on the program. Fantastic for you to join us. We've got much to talk about, but let's start with Morgan Stanley and James Gorman. We've been waiting for this for a while. He had a massive impact on the bank and on Wall Street. I'm sure you've met him on multiple occasions. What impact did he have on the banking world from your perspective?
Yeah. Well, I think he's had a good tenure. He moved very quickly to de-risk Morgan Stanley, to move it into other business areas that do not involve balance sheet risk. And he seems to have, recruited a strong board, strong senior management. They've been not public about succession planning, but it appears there are 3 internal candidates. So there has been some succession planning. Like any good CEO, if you're going to eventually leave, you need to make sure that your company's ready for the next round of leadership. So overall, I think, job well done. Congratulations to him. Leaving on his own terms, which is also always good when Morgan Stanley's doing pretty well.
So Sheila, to that point, he did a 14-year run as a CEO. A lot has happened in banking in 14 years. Can you just give me an idea of sort of where the banking industry sort of was when he started and sort of now what it's become?
Right. Well, it's become less risky. I mean, he took over during the great financial crisis. Both Goldman Sachs and Morgan Stanley became bank holding companies. So they were subject to much more rigorous safety and soundness oversight than they had been before when the SEC was a primary regulator. And the SEC is a great regulator, but they're markets regulator. They don't really look at prudential issues like capital and liquidity. That's what more banking regulators and the Fed do. So that was a huge transition. That was a huge cultural transition for Morgan Stanley. Goldman, ill-advisedly, with their new bank charter in deposit insurance, tried to get into retail, which didn't work so well. But I think Gorman focused more on, wealth advisory, wealth management, which the clientele that perhaps was more suited to Morgan Stanley's strengths. So, like I said, I think he did well. He managed Morgan Stanley into this very much more intense regulatory environment. And Morgan Stanley's done well.
Sheila, are bigger, lower risk banks better than smaller, higher risk banks? And is that the challenge we now face?
Right. Well, I'm not sure I would say that the bigger banks are less risky. They certainly do have some regulatory requirements that do not apply to the smaller institutions. I still think that, we need to be vigilant with the large banks. One of the issues with the large banks is their complexity and their trading operation, the derivative operations, their the global reach. It's much harder to understand for a supervisor to understand what's going on inside of them. It takes a much more intense effort. Whereas with the smaller banks, they have some of their issues too, but examiners, I think, feel they can get their arms around what those issues may be for the larger banks. We also lose some market discipline with the larger banks. Let's face it, I want to think that Dodd-Frank ended too big to fail, but I'm not sure it did, and I don't think the market believes that. So there's less market discipline around the big banks versus the smaller banks, and that can lead to more consolidations we're seeing now with deposit migration to these banks that are viewed as too big to fail, especially JP Morgan Chase.
So to this point, Sheila, though, I mean, we didn't have our arms around the regional bank crisis that
no, we
happened.
Didn't. That's true.
Is it over? Do you expect more fallout?
Yeah, well, it's a fair point, and I'm going to hope that some of the supervisory lapses, especially with Silicon Valley, were aberrational. Just as I think that the gross loss, lack of management acumen, shall we say, at Silicon Valley was an outlier. So I continue to think the supervisory system is much stronger. I know it is than it was during the Great Financial Crisis. Certainly, capital is much stronger. The supervisory process, they made some mistakes. Both the FDIC and the Fed have owned up to those. I think they're very much on top of it now. So there will be some more failures. I don't suggest that, but they're going to be manageable. And banks go through cycles, banks fail. There's 4,100 banks out there, 23 trillion in assets. I think a handful more failing should be something that the system can handle, the FDIC can handle, and depositors should not worry. If your household, stay below the insured deposit limits, so please.
The danger is maybe we get an overreaction, a regulatory overreaction, Sheila. In Europe, all banks are basically ruled by the same rule book. In the United States, as you've indicated, that's not. Michelle Bowman, Fed governor, a little earlier was just addressing this issue. Let me just read you what she had to say. The view that we extend the reach of overly complex and outsized regulatory requirements to banks that are smaller and less complex ignores some of the likely risks, likely results. Doing so will lead to bank consolidation and will potentially push banking activities outside of the regulated banking system. Do you share those concerns, Sheila?
Well, I do think that it is appropriate to adapt regulatory and supervisory approaches to not just the size, but as we said earlier, the complexity of the organization. So I do agree with her. I don't think this, I've always said that we did not have some kind of wholesale deregulation of regional banks. The rules that apply to them are for the most part, the right ones. There are some discrete areas where I think we could have done a better job. For instance, how you account for unrealized market losses, better transparency around that, better requirements to make them deduct those unrealized market losses, at least those are called in their so-called available for sale portfolios. Those are things we could probably do better. Resolution planning around regional banks probably could be done better. So I think they're targeted. I agree with her. First and foremost, we should be asking why the rules we do have didn't work in these instances. You didn't need enhanced prudential standards to understand there was something going very bad with Silicon Valley Bank. So first and foremost, let's make sure we're enforcing the rules that we have. And if we're going to be rethinking some of this, let's think about complexity too, and how the complexity around some of the capital liquidity rules actually creates a distraction for boards of management when they're trying to manage the risk and identify the risk in their bank. And I do agree with Jamie Dimon, especially on the stress test. They become, and to some extent resolution planning for the larger banks, they become horrifically complicated and do become a distraction to the extent they don't reflect the real world. As we're seeing, they didn't reflect the fact that even government security is very risky, and that should be looked at as well.
So Sheila, if I'm a regional bank CEO, am I hearing you and thinking that I'm going to have more regulation, or I'm going to have to put more money in reserves, or my books are going to be scrutinized more and therefore I'm going to lend less? Like, is that my takeaway from listening to you?
Well, I think, look, the two areas that I think are most likely for regional banks, and this is going to be primarily the Fed's call, is one, whether they have to deduct from capital unrealized market losses in securities that are held in their available for sale portfolio. That the vast majority of banks in Europe have to do that. We only require it if you're above $750 billion, which is a pretty high threshold. So I think you can expect something on that. I think you can expect something on requirement to issue long-term debt. which is another way to protect uninsured depositors, because if a bank fails, that's below the claims priority to the uninsured. So I think, yeah, you're probably going to be seeing action, but I think they're going to be thoughtful. They're going to go out for comment. They're going to, provide transition periods. And some targeted changes, I think, are going to be fine, and the regional banks can handle them.
Do you think the regional banks can handle significantly higher rates from here? You talk about the available sale bucket, the hold to maturity bucket.
Right.
Some of the bonds that are in these buckets are very low yielding, and the Fed could be going higher from here. If we do see the Fed raising significantly from here, Sheila, what impact do you expect?
So I hope Yes, I thought they should have hit pause last December, and I'm an inflation hawk, but they've just been going really fast. And, if they want a soft landing, they need to give the economy and the financial system time to adjust. So I'm hoping that we're seeing some positive signs. Actually, I think some spending reduction on the fiscal side will also help. People say, oh, no, this is going to slow the economy. Well, I think we do want to slow the economy a bit to, reduce demand a bit. It's just creating pressure on labor costs and goods and services costs. So, and we're seeing housing starting to correct. Housing's a big component of inflation, consumer inflation. So there's some potentially positive trends right now. And of course, it's painful for your value of your home price to go down, but you know what? The vast majority of homeowners have a lot of equity in their home. They've got fixed rate mortgages, so they're not paying higher rates. And so I do think there's some positive trends that can help the Fed. And perhaps, they need to assess, and perhaps they will not need to raise rates anymore. That would be nice, but we'll have to see.
Yeah, that's a really good point. Yes, we may see decreased fiscal spending, but that's maybe not a bad thing. Sheila, we appreciate it. Thank you very much.
Sure.
Sheila Bair, Center for Financial Stability Senior Fellow. A real sincere pleasure. All right, coming up, more on the question of the day. What is Morgan without Gorman? We're going to talk to Jared Cassidy, RBC Capital Markets Head of U.S. Bank Equity Strategy. This is Bloomberg.
Keeping you up to date with news from around the world, here's a first word. I'm Lisa Mateo. White House negotiators say they're making steady progress toward reaching a debt limit deal. In a call from Japan, where President Biden is attending the Group of Seven summit, Biden told them he's confident Congress will act in time to avoid a default. House Speaker Kevin McCarthy has said both sides may reach an agreement as soon as this weekend. The 14 countries in the U.S.-led Indo-Pacific trade talks are close to an agreement on supply chain coordination. Bloomberg's learned a deal could be announced as soon as next week. The focus is on systems that would provide early warnings when countries see a risk of supply chains being disrupted. Republican Senator Tim Scott reportedly will begin airing TV ads in Iowa and New Hampshire next week. According to the Associated Press, Scott also plans an announcement on his potential run for president Monday in his hometown of North Charleston, South Carolina. Last month, Scott formed an exploratory committee allowing him to raise money while weighing a White House bid. Global news 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Alex.
All right, Lisa, thanks so much. Let's get to our question of the day. What is Morgan without Gorman? I'm looking at the stock right now. It's kind of taking a leg lower here, now down by 1.5%. A kind of steep slide over in the last half hour. Jared Cassidy, RBC Capital Markets head of U.S. Bank Equity Strategy, joins us now. He's a sector perform rating on the stock with an $80 price target. What is Morgan without Gorman? What's the Gorman premium? We got to price out right now.
Alex, I think certainly you're going to see the stock trade off a bit because James Gorman has done a very good job in turning Morgan Stanley around from the financial crisis to where it is today. He's diversified the business mix of the company and has been rewarded with a better than peer average valuation. So, of course, this type of news, which is not shocking because we all knew that when they realigned their executives about 18 months ago, that his retirement days, were coming soon.
Gerard, somebody is going to take over. Who do you think it's going to be, and are they a continuity candidate?
When they reshuffled senior management about 18 months ago, Ted Pick and Andy Saperstein were the two individuals that were made co-presidents, and they're the heir apparents of James Gorman. It's a horse race. It's neck and neck. Clearly, as outsiders, we don't know for sure who will take over because the diversity and the shifting of the business of Morgan Stanley over the last 15, 20 years, diversifying more into the wealth management space has been a real success story of Morgan Stanley. So it's hard to say which one will be chosen to replace James Gorman, assuming it's one of those two.
Why do you think the stock is down right now? Maybe an unfair question. It's a day of move. I get that. But why do you think the market's having this more negative reaction right now?
I think it's because his leadership has been so strong. He's been the face of the company for so long, and it's the unknown. It's the unknown of who will replace him. It's the unknown of how well they will do. It doesn't necessarily mean the replacements are going to do any worse than James Gorman. They could be even better. They could have better plans, better strategies. So, but it's just the unknown is why I think the stock is down.
Alex, we should probably talk about the other Morgan here as well. JP Morgan. Investor Day Monday. Pressure's on.
Yep, pressure's on. Gerard, we're going to hear from Jimmy Dimon. Is he going to be like, all right, guys, I guess I'm going to retire? We're going to get the 5-year thing again.
No, Alex, I think we're going to get the 5-year thing again. I think Jamie Dimon is in his element. He's enjoying his job. He's in the center of the fight. He's there to help with policy in this country, in the banking industry, as most recently evidenced with the crisis that we came, or the turmoil we came through with the 3 banks that failed. So I don't expect to hear this type of news Monday from J.P. Morgan or Jamie Dimon.
I'm sure the question will be asked, though. Gerard, have a great weekend. Thanks for stopping by. We really appreciate your time. Gerard Cassidy of RBC Capital Markets. Coming up, we're going to turn our attention to what is happening in Japan. G7 leaders meeting there. We're going to have the latest from what is happening and what we should take away from it. The president, obviously, one eye firmly on the debt debate in D.C. We'll talk about it next. This is Bloomberg. So Bloomberg has learned the G7 will look to increase pressure on Russia and is looking to deliver extra sanctions and restrictions on Russian goods. This as the Ukrainian President Volodymyr Zelensky is on his way, we understand, to Hiroshima to meet with G7 leaders in person. Joining us now from Japan, Bloomberg's Anne-Marie Hordern, our Washington correspondent. Anne-Marie, this meeting was already going to be about Russia. It was going to be about Ukraine. It was going to be about trying to end this war. How will Volodymyr Zelensky's arrival change the tone? What impact is he expected to have?
Well, Guy, I think what you've seen him do in London and Berlin and Rome and other European capitals is he's going to come here with a message as Ukraine is about to have this counteroffensive, asking for more weapons and asking for more support and just making sure that he is showing up to these meetings. It's pretty incredible that this will be the first time how far he's traveled since the war began. Coming here to Hiroshima, we should also note not very far from the eastern part of Russia. Obviously, Japan shares that border, in a sense, the sea border with Russia in this neighborhood. He's also coming off a meeting, we should note, to the Arab League. He will be sitting down today with Middle Eastern leaders. Notably, Saudi Arabia will be represented there, the UAE will be represented there, so he's clearly trying to have this global push to make sure that he is going to have the support out as they go into the counteroffensive, because the message has been very clear from Ukraine. They're going to need to continue supplies of not just aid, but serious weapons and ammunition as they want to try to stop Russia and gain back some of this territory that Russia's been able to hold.
Anne-Marie, at the same time, President Biden has to be keeping one eye on D.C. and the debt ceiling talks. How's that going? Like, how's the two-focus trip there going?
Well, that's right. He has, one ear on the ground here and the other one firmly back in Washington. Early this morning in Japan time, late evening D.C. time, he had a call about 20 minutes with his core negotiating team that is dealing with the Republicans. A lot of mood music is showing that they are progressing into the weekend. Speaker McCarthy said potentially there could be an outline in principle, a deal over the weekend, and the president certainly would like to see that. He then left this evening a G7 dinner early to make sure that he can have time to get an update from his team as they are about to enter the U.S. day and, of course, go into another big negotiating day because it is Friday and the president will be getting home on Sunday. And it does seem that they really want to try to hammer this out as soon as possible. It feels like there's a lot of concern about the X date definitely falling potentially as early as June 1st, and the president wants to be able to deliver. So that has been a major concern for him here at the G7. We also should note he's meeting with leaders that also want to make sure that the United States is not going to default on its debt. So he has really two reasons why he needs to be concerned with what's going on at home at Washington.
Busy day for the president. Anne-Marie, busy day for you. Thank you very much indeed for joining us. Anne-Marie Hordern joining us from the G7 in Hiroshima. Let's talk about what is happening with the markets right now as we come through to the end of the day here in Europe. The stock 600 up by 0.9%. We've got a little bit of momentum starting to come into these markets. We've also got Max DAX. Here we go. 16,322, 16,271 I think is the closing previous record. 90 was the intraday high. We're through that. We're up by a full 1%. And euro dollar through 108 a little bit earlier on, retreating back, but still up by 0.2%. Christine Lagarde speaking a little bit earlier on, talking about the idea that we need to buckle up because the ECB needs to make sure that it gets inflation back down to target, i.e. 2%. We're going to talk about all of this in the next hour. Have we hit Max DAX? We're going to be joined by Emma Wall, Hargreaves Lansdown, Head of Investment Analysis. That conversation is next. This is Bloomberg. Friday, the 19th of May, European stocks get some momentum into the end of the week. The DAX hitting fresh record highs. The question is, have we hit max DAX? Is this as good as it gets? Is it downhill from here? The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So positive stock momentum, let's talk about it. The stock 600 up by 1%, retaking 470. The technology sector has been a big part of this. Is this AI FOMO? Certainly the chip sector has been a big driver. I'll show you that in a moment. The DAX, here we go. Fresh record highs for the DAX. Looks like we are cruising into the close. Almost certain it looks like of a fresh record. We took out the intraday high a little bit earlier on. Are we going to take out the closing price, which is a little lower? We're up by 1%. And then I mentioned what's happening with the chip sector. ASM Osram up by 6.29%. It's a little bit of a hangover from the gains we saw yesterday in the Philadelphia Semiconductor Index, but it's a narrative that is happening around the world. Chip stocks certainly on a tear. Is this the baby bubble that we are seeing in AI stocks? And how much of this is FOMO? How much of this is reality? Is this like 1999? Lots of questions need to be answered there, but certainly that stock, Alex, having a very good day.
Yeah, and baby bubbles can grow to bigger bubbles, and then you miss out on the bubble before it bursts. So lots of questions around that. Okay, so interesting fun stuff happening here. The S&P up 0.3%. We know the Morgan Stanley story. That stock was rolling over a bit, so we're kind of off the highs. We're over 4,200. If we stay above that, that could be really kind of shake up the options market a little bit. We have 1.7 trillion options expiring today. Now, where we see that read through, so the triple Qs flat today, but had a big melt up yesterday. And one theory is that perhaps this was actually, if you're selling a call, you're going to have to buy the triple Qs to kind of offset. So it's that gamma hedging that we talk about, and that helped the melt up. The melt up, though, leads to FOMO, and then it leads to other investors and funds being like, I'm sick and tired of fighting this rally. I'm just going to get in, and that's helping that upward pressure overall on stocks.